Welcome to this special episode of Prinsights Global of the fantastic Substack, the Macro Butler, among so many other hats that he has. He was on with us a few months ago, had some very specific targets on gold and other commodities and where investors should be in their portfolios. And I'm so happy to have him come back in the wake of the first Fed cut of the year and so many other things going on about the world. Laurent, thank you so much for joining us again.
Naomi, it's a pleasure to be back on your show.
Thank you. And we have a lot to get into, but I wanted to talk a little bit about the piece that you just wrote. And I love the title, which is Trust Bonds at Your Own Peril, because I think trust in general is such a key theme for the markets, for investors, for central banks, for governments, really in general. It's such an important factor. So can you give us a little bit of a backdrop on how you see trust in the markets and what that means for bonds and other commodities?
I think that over the past few months and even since, I would say, the start of this decade, we have seen a lot of shift in terms of trust. And I always look at our investor trust public institution versus a private institution. So I think that in the current environment, and this has been particularly true over the past few months, we have seen a complete shift out of the secular trust that we were used to have in public institutions, and the trust is in fact moving into private institutions. So this is usually the case when we are navigating very chaotic environment. So everyone knows that we are in a very chaotic geopolitical environment. But also, if you look domestically in almost any countries in the world, you can see that governments are also facing distrust from their citizens as well as from investors. So for investors, what is very important in terms of trust is, if you remember, when you can invest, in fact, you can invest in two types of assets. You can invest in contracts, which are mostly bonds and cash, and you can invest in properties, which are mostly equities and physical gold or precious metal. And what we have seen throughout history, and we are experiencing right now, in fact, we see that when investors are losing their trust in public institutions, in fact, they are running away from contracts, i.e. bonds and cash, and they are pouring their asset or their investment into properties like equity and physical gold or precious metal in general. The people who have used to be invested in emerging markets know that very well. Through decades, a lot of emerging markets in Southeast Asia, in the Middle East, in Eastern Europe have experienced a lot of crisis, government crisis, crisis of confidence in the public institution. And what we have seen over this period of time is that investors are piling into properties such as stocks and bonds, stocks and precious metals, and are avoiding cash and bonds. And in fact, that's what we have seen also most recently. If you take the example of Argentina, before President Milei took power, the Argentinian stock market in local currency was making new highs almost every day. So it's not something that is unusual throughout history, but I think that what is unusual is that we see this phenomenon happening in what is still called developed market or Western economies. So you can look at the case of Germany, where the DAX, in fact, has made new all-time highs in euro. I mean, this is because most local investors, are avoiding to invest in local government bonds and focus on equities. And in fact, the same is kind of also developing in the US. So a lot of investors, a lot of analysts are questioning why the stock market is doing so well, why the mega cap are doing so well. And in fact, it's just because one of the reasons I would say is because a lot of investors are reallocating their asset from cash and bonds into equities and gold. So all in all, what I try to explain in this latest newsletter is that a lot of people have been used to see government bonds and even cash as the risk-free asset. But in reality, in the current environment that we are, bonds and cash are not at all a risk-free asset, and they become, in fact, the risky asset. And the risk-free asset, in a way, is found primarily in physical gold, but also alternatively in equities of shares of good companies, well-run companies with strong balance sheet and low financial leverage. And so, I mean, like even that most of analysts try to convince all investors that the US stock market is overpriced, the reality is that in the current environment, valuation doesn't really matter. I don't say here that we are not going to see a correction from time to time in equities or even in the gold price. I think that investors should be used also in the current environment to see much higher volatility, and meaning that they should be used also to see 10 to 15% pullback in the gold price or in equity market. But over the long run and the long term, in fact, the risky assets are bonds and cash and not equities, and for sure not at all physical goods.
Right. I think you mentioned this the last time we spoke as well, that, any pullbacks, which happen in any market at any, over any period of time or can happen are really buying opportunities, for gold specifically. And, it's interesting. You mentioned in your piece that, and you said it just now, that the idea of risk-free assets is really a Wall Street favorite fairy tale, that really, when you have so much of a debt overhang by more developed countries really than developing countries, that's one of the major drivers for what's pushing both the equity markets and the gold markets. And so right this year, gold has outperformed the SP 500 by a significant amount. How do you see that relationship moving over this quarter or into next year?
I think that we will continue to see outperformance of physical gold against equities. I mean, there are many more drivers also behind the performance of physical gold. One of them is that a lot of central banks, mostly in Asia and in the global south, are reallocating their US dollar assets into physical gold. These kind of investors are not price sensitive at all. I mean, a lot of central bank and institutional investors, especially in the global south, have understood after February 2022 that it can be dangerous for them to own US dollar assets after what happened to the US dollar asset, which were owned by the Russian companies and Russian central bank. And so they understand that it's a must to protect themselves against, let's say the reality, against the still prevailing US imperialistic agenda. They must continue to reduce their holding in US dollar assets, And the only alternative they have today is to buy physical gold because there are currently no other asset which is liquid enough and which is non-confiscable available to them. So I think that until we see a geopolitical tension between the West and the East, until we see wars evolving in Eastern Europe, in the Middle East, and elsewhere in the world, we will continue to see this kind of investment from institutional investors from the global south.
Right. It's so fascinating. You are so ahead of the curve really in how you think, how you've helped investors, how you've helped high net worth investors around the world. I so appreciate your perspective, Laurent. And it's interesting because what you've also brought up just now is the idea of not just an actual default, but the sort of technical default where nobody shows up to buy your bonds. We're seeing that happen in conjunction from the East relative to the West and developing countries versus developed as they put more gold in their reserves. And we've seen investors and ETFs follow suit. So a lot of things to come. Can you just tell us and everybody watching here today how to find your work and a few parting words of wisdom for how they navigate their portfolios over this quarter, really over the near term? We've talked a lot about the far term, but just for now as well.
Well, I think that everyone should be ready for much higher volatility in the next few days, weeks, and months, and at least until the end of the year. I think that, in fact, the recent geopolitical event could easily trigger this much higher volatility. Also, what's happening in Europe with France, which is on the edge of I would say, asking for an IMF bailout because of the political gridlock that the country is, could trigger much more volatility. I would say that the US will still do much better than the rest of the world because the US will keep attracting fund flows, especially from Western investor, from European investor in the next few weeks and months. So I would think that the most likely pullback, and I won't rule out, let's say, a 5 to 10% pullback in equity market. I think that would be also very healthy to have such a kind of pullback. Will be a buying opportunity in US equities. And I think that investor will have to focus on quality stocks. So also, if I look at history, and I think that this is also something that a lot of people missed, is that when the Fed start cutting rates, in fact, usually is the time where the Dow Jones start to outperform the Nasdaq. It's also the time where energy producer like oil and gas companies start to outperform energy consumer like the IT sector. So I think that investor should be ready for much more volatility as well as kind of a rotation from, I will say, what has worked so far this year, which is still the Magnificent Seven, into much more traditional companies or even the energy sector, which I think is still very underowned. I think that there are, I mean, even after the rally, there are still a lot of good opportunities in the mining sector. Even outside the precious mining sector, I can see a lot of interesting opportunities in copper mining and other mining companies. I think the sector is on the verge of a consolidation, which is always good for shareholders in the future. And I will say also that because the US will be heading into a midterm election next year, I mean, it's almost 14 months, less than 14 months from now. I will think that at some point the government would also need to address the lack of infrastructure in the US. So outside the digital infrastructure around the Stargate, I think that in fact the physical infrastructure could be also a sector that will benefit ahead of the midterm election. And there are a lot of ways to play this kind of thematic in the US via big caps or smaller caps or mid caps. So I think that the next few weeks and months will be very interesting. I must see, I guess, a very kind of a rotation, which will probably scare some investor. But I would tell everyone stay disciplined. Look at the long-term horizon. We all know that the problems are in the fixed income, in the bond market. It's not really the problems are not really in the private companies, in the equity market. So I would think that this upcoming pullback will be a good opportunity for everyone to add on these quality stocks.
And on gold, if you're not allocated, or if you're only allocated for, a couple percentage points, what do you suggest?
Well, it has been very difficult for investors because gold price has made all-time high almost every day over the past 1 month. I would say that if you are not allocated at all, you must start an allocation. And the best way is probably to do a dollar cost averaging strategy. If you are allocated, I would think that you can try to look for a pullback, but I don't think that we will see a major pullback. Probably $100 pullback would be a big opportunity to add on gold. I mean, I recommend for almost 2 years for everyone to hold between 25 and 40% of their portfolio in physical gold. I know it's very difficult for most investors to get to that level of allocation, but I mean, I still see a lot of portfolio with 30, 40, or 50% fixed income, which I think, in fact, is a problematic because not only you are losing on the fixed income side of your portfolio, but you are also staying behind in terms of the lost opportunity in the gold price. So my recommendation, I mean, timing is always difficult, especially in the bond market. So I would advise everyone to do a dollar cost averaging strategy. And if they know that they need to reach, let's say, 30% of their portfolio in the next, in 12 months' time, I mean, the best is to buy on a regular basis every month, whatever the price is. And like this, in fact, they will adopt probably the same strategy as the central bank in the global south, and being a bit less price sensitive than for other assets. I think that it's much more important to be right on the market timing in the equity market rather than on the gold market. And I mean, my best advice to everyone would be to really notice that the risk is in the fixed income market, the risk around governments, and the risk are not around the private sector, the risk are not around the good corporates. The good corporates will continue to do well. And again, I can just name what happened in the recent past in Argentina, or what happened in Turkey, where you can see that when the president start also to intervene in the monetary policy, in fact, it's another trigger for the stock market to move higher, because it's another trigger for investor to move away from public contracts such as fixed income and government bonds, and to move into private property like stocks.
Right. That's all fabulous wisdom and information. Again, Laurent, coming to us from Singapore, from around the world. And can you just give our viewers and listeners today some information about how to find your future words of wisdom and your writings?
Well, I write a weekly newsletter on Substack called the Macro Butler. I also just started a Telegram channel where I put some more, I would say, daily thoughts because my newsletter is weekly. So from next year, we will be launching a monthly newsletter, which will be for subscriber only. And then we are also looking to launch a financial academy because I'm very committed to develop a financial literacy. So I'm looking to create a class where all kind of investor can learn how to invest, even if they have a minimum amount of, let's say, $1,000 or $5,000. And then if you are high net worth individual, in fact, I help high net worth individual to navigate these difficult times and challenging times. So you can contact me at info@themacrobutler.com. I will offer you a complimentary review of your portfolio, and then you can decide if you want to hire my service or not. And everyone also can send me an email at info@themacrobutler.com. I reply to all the emails. I'm always happy to know everyone's point of view. I'm happy to debate with people who don't agree with my view of the world.
Well, I appreciate you, Laurent. I'm fascinated by what you do, by your way of thinking, and I know you've helped a lot of people make a lot of money. So again, I thank you for your time coming on today, and I hope we can continue this conversation going forward. Thank you so much.
It's my pleasure, Naomi, and looking forward to be again on your show anytime soon.
Thank you. And to everyone joining us today, thank you so much for viewing and listening to this episode of Prinsights Global Spotlight.